Okay, thanks, Linda. So I'm happy to present this paper here. It's a paper with Rachel Cordonier and Ouarda Merrouche, and they have most of the merit for this paper. So this paper is motivated in part by a big change after the global financial crisis that has led to a decline in international bank lending throughout the world. This is true for developed countries where market borrowing is now much larger than bank borrowing, but also for emerging markets where market borrowing has increased while bank borrowing has declined, even though bank borrowing is still more important. So this is true in general, but it also applies for corporate bonds. We see an increase in corporate bond borrowing, and in particular in foreign currency. So the literature on international borrowing and foreign currency borrowing has focused a lot on bank loans, bank borrowing. And it may be that bonds borrowing raises different issues or may be motivated by different factors. And it can be that bonds are more sensitive to the global financial cycle because it is related to the behavior of international investors rather than the behavior of banks. And in particular, there's the role of the dollar where the dollar market is particularly important for bond issuance. US monetary policy is important with low interest rates until recently. That has led to a search for yield, and it seems that it's cheaper to borrow in dollars. So this is also a reason to have this foreign currency borrowing. So there may be different reasons, there may be different implications, and there may be also different policy issues. If you have bank borrowing, you can have macroprudential policies that control or limit these positions. But when you go to market borrowing, you cannot use this, and maybe there's a role for capital controls. So this is the motivation of the paper, and what we do in this paper is to use firm-level data to examine corporate bond FX borrowing. And we look in particular at risk factors, at US monetary policy, and examine the role of capital controls and macroprudential policy, and with this firm-level data. So we have 16 countries with quarterly data, and for the private non-financial sector, for publicly issued corporate bonds from SDC Platinum. And we match this data with firm-level characteristics from WellScope and Orbis. This is where most of the work is in this project. So you have to do this by hand, and it's a lot of work. But by having these firm-level characteristics, so these are the right control variables, so we can better estimate the impact of global factors and the impact of capital controls, macroprudential policies. Because of this matching, and because we also use other data on capital controls, macroprudentials, this limits the number of data on bond issuance, but we still have 4,600 in the sample. The capital control, we use Fernandez et al. It's a well-known database, and macroprudential, we use mainly Anhurt et al., and we double-check with Cheruti et al. Okay, the methodology. So this is a purely empirical paper, and this is the only equation I'm going to show you here. So the idea is to look at the proportion of bonds that are denominated in foreign currency, given that there is a bond issued in a given quarter. And this proportion is called FX of FIJT. So this is the share for firm F in country I, in industry J, in quarter T. And we use a fractional logistic model of this form, where we have firm level data, which is F, industry control data, which is I. I'm not going to talk much about that, it's more for robustness. Country macro control and global variables. Now, this is a non-linear form which we can also then exploit to look at heterogeneity across various characteristics. Okay, now in terms of these variables, we will take what is available, and we have a long list of these variables. I'm not going to list them all, but you see here the list of firm level variables, like high yield flag or cash, book to market value, etc. I will show you those that are significant. Some of them are just not significant. For country level data, we have GDP growth, exchange rate volatility, the exchange rate regime, etc. And the main, well, we will also have capital controls on bond inflows. And then for the global variables, we have different measures of US monetary policy, shadow Fed fund rate, then measures of uncertainty, VIX, and global uncertainty, etc. Now, when we run these regressions, I'm not going to show you the full tables because it's pretty long, but I can just mention what are the firm level variables that matter and some of the country level variables. We find high yield flag, cash, profitability. These are systematically significant. Country level variables, the exchange rate regime, interest rate, derivatives, derivative market, etc. We find that FX debt is more prevalent in countries that are less developed, have a higher interest rate, have strong regulatory quality, or strong derivative market depth. But the objective of the paper is not to look at these variables. These are more like control variables, to look at global variables and capital controls. And this will be the focus, and I'm only going to show you the results with these variables. So when we run this regression, actually I say I run, but I didn't run the regression. We look at this regression with all the country level variables, with all the firm level variables that are not shown here. And here we have I'm showing you a baseline case where we have a measure for US monetary policy and a measure for risk. And they are both significant with a negative coefficient. It means that when, for example, the US interest rate goes up, you decrease the foreign currency borrowing. You borrow less in foreign currency, or the opposite, when the US interest rate goes down, you borrow more. And this is economically significant because if you have actually there's a typo, a decrease in the shadow Fed fund rate by 1 standard deviation, this will increase FX issuance by 13.6 percentage points. For global risk, if you have an increase in VIX by 1 standard deviation, it raises FX issuance. If you have a decrease in the VIX by 1 standard basis point, it raises FX issuance by 12 percentage points. So these are significant variables. So there is more foreign currency borrowing when US interest rates are low, when risk is low. We can use other measures of risk, like US interest rate. We take long-term rates instead of the shadow rate. For risk, we use a post-crisis dummy, or we could have the move or global uncertainty. Results go in the same direction. Now, because we have this nonlinear specification, we can look at the impact of these variables for different characteristics of firms, which is important for financial stability. For example, we look at leverage, and if we look at different levels of leverage, what is the impact of a change in the Fed funds rate on the probability of issuing foreign currency debt, depending on leverage? We see that if you have very high leverage, this is not significant, which is good news. But still it is significant up to like 35% of leverage. So it is still significant for lots of firms. We find that there is a stronger impact for larger firms. It's in that large firms are more impacted. I'm not showing you the picture. And there's also a stronger impact, surprisingly, for domestic-oriented firms. Here we don't have like a precise measure of how open or sensitive is a firm to foreign variables, but we look at the correlation between their income and the exchange rate. And if they have a high correlation, we say that, well, they are more open, and if they have a low correlation, then they are more domestically oriented. And we find that the changes in the Fed fund rate will impact more their FX borrowing if they are more domestically oriented. It may be that in normal times, the firms that are already open, they already borrow in foreign currency. So maybe a change in the interest rate doesn't make much of a difference. But for those firms that are more domestically oriented, they really have a change when there's a difference in the interest rate. Okay, so that's what we can say about the interest rate for the uncertainty. We also have analysis of these heterogeneous effects that I'm not showing you here. Because the next thing we analyze is the impact of capital controls. So in this same baseline regression that I showed you before, there is another line, which is the impact of capital controls on bond inflows as a dummy. And here we find that it is also significant. So if you have capital controls on bond inflows, this will reduce the proportion of foreign currency debt. And this is true with all our different specifications. Now, the coefficient is significant, economically significant. And actually, we can see that the presence of capital controls can actually neutralize, on average, the impact of the US interest rate. So, well, first, the controls on capital flows reduce propensity to borrow by 15 percentage points. And then it can neutralize the impact of the interest rate. Here we have our dummy of capital controls on inflows. It's 1 if there are controls and 0 if there are not. And this is, again, the marginal effect of the Fed fund rate. And if you have controls, it is insignificant. And if you don't have controls, well, then you have significant effect. And also what we find, we can look at the impact of capital controls at different values of the US interest rate. And we find that capital controls are particularly, or are significant when the US interest rate is very low. So here we have the level of the interest rate, and here we find that capital controls are significant when this shadow Fed fund rate is negative, but not when it is positive. So this would be consistent with the search for yield story that would may lead to more dollar lending and a larger impact of capital controls. So this analysis would tell us that capital controls could be used as prudential instruments when US interest rates are low. Now, since we talk about prudential policy, we also look at macroprudential policies and how do they interact. So we use these indices in the paper by Anhert et al. And they found in their analysis that surprisingly, macroprudential or some macroprudential policies can have kind of a negative spillovers on bond borrowing. And we find the same thing here. If I run, so I should look at the column 4 here. If I run the similar baseline regression as before, where I have the Fed fund rate, the VIX capital controls, and I add FX regulation for the banking sector, FX, so these are regulations on on liabilities, assets and liabilities in FX in the banking sector. We find that this is significant, but it has a positive sign. So when you have more regulations on FX in the banking sector, then firms tend to borrow more in a foreign currency in the bonds market. There it means that, and the capital controls are still negative. So the two go in opposite directions. So this shows that these two instruments could be complements, because you can control the banking sector for macroprudential and you could limit FX exposure in the banking sector. But then you need to use capital controls to also avoid the spillover and limit FX exposure from corporate bond borrowing. Okay, so this is the analysis that we run in these larger regressions for the use of capital controls as a useful instrument that could be a complement to macroprudential. Then some of the rest of the analysis, we look at the implications of capital controls at the firm level. What are the implications beyond reducing the FX exposure? So one thing we do is to look at the impact of exchange rate fluctuations on stock returns, and this is inspired by the paper by Anhert et al. Well, exchange rate fluctuations impact stock returns in general, but when there are capital controls, we show that this dampens the vulnerability of from exchange rate fluctuations. While for macroprudential policy, we find the opposite. Then we look at the real impact of capital controls. We find that there is a negative impact on employment, especially for large firms. Large firms appear to be more impacted by capital controls, mainly because they need to borrow more in these public markets. And we also find that the domestically oriented firms have a negative impact on sales and a positive impact on debt. Okay, so this is the conclusion. So low interest rates increase emerging market FX corporate bond issuance. This is part of this recent trend, which makes emerging markets more vulnerable. And this contributes to the global financial cycle. Low interest rates contribute to a boom, but when we are in the return of a situation currently, when the US increases the interest rates, then emerging markets are more vulnerable than before the interest rate was lower. So this increase in FX borrowing when you have low interest rates make emerging markets more sensitive. So this amplifies the global financial cycle, but it can be dampened by controls on capital inflows. And we also show that especially for controls on bonds purchased by non-residents. Capital controls can reduce the impact of exchange rate fluctuations on firms and can be used in combination with macroprudential policies. One question is whether these controls are desirable. They have some negative impact. And in this empirical paper, we are not able to draw like welfare or policy conclusions. This is for further work. Thank you.
So this is a paper also on foreign currency debt, but we're going to look at the role of expectations. And it's joint work with Isabella, Blengini, and Ouarda Merrouche, who is also a co-author of Philippe. Okay, so yeah, corporate foreign currency borrowing has been at the core of financial fragilities in emerging countries for some time now. So we address the general question of why do emerging markets firms borrow in foreign currency? So to explain our approach, we can look at the UIP deviations. UIP deviations, well, it's an interest differential, so between the peso rate and the dollar rate. And it should be equal to the expected depreciation, and maybe with a risk premium. Now, different approaches have considered different parts of this UIP. So the spillovers of US monetary policy, that was Philippe's paper, for instance, but there are also other people who have looked at that. The role of country risk that drives a wedge between the peso and the dollar rate also plays a role. We're going to have a different approach by looking at asymmetric information on the country's fundamentals, so we will focus on the expectations. So what's the idea here is that, well, foreign currency borrowing will happen, well, for all these reasons, but also if the interest differential, which is equal, well, which is priced by foreign investors, okay? So this interest differential should reflect the foreigners' expectation about this probability of depreciation and about the country's fundamental, in a sense. But the domestic borrowers, they might have a different view. And they will typically borrow in dollar if they think that actually their currency is more solid than what the foreigners think. So this is our approach. So we call this an expectation channel. And one crucial question, if you think that some of the foreign currency borrowing takes place through this expectation channel, is whether domestic borrowers have actually better information on the fundamentals than foreigners. So these are this is one question that we will try to answer as well. Another motivation is, well, empirically, the role of fundamentals is not very strong. Well, if you take the point of view of common wisdom, that firms in a country with bad fundamentals will be required to borrow in foreign currency, so that's the original thin story. But it's a supply-side story, you know, so it's, yeah. So this common wisdom, and this, which is based on theories that focus on supply-side determinants, implies that fundamentals should explain foreign currency borrowing. But empirically, we don't see such a strong relation between fundamentals and foreign currency borrowing. So a phenomenon that we call a fundamental disconnect. Okay, disconnect between foreign currency borrowing and fundamentals. And there is also another fact, which is a kind of a stigma effect, where countries which have actually improved their fundamentals over time still are required to borrow in dollar. So yeah, in a sense, in these countries, the better fundamentals are not reflected in their foreign currency borrowing. So we're going to explain that disconnect as well. So in the paper, we provide a theory of the expectation channel, where we show the role of information asymmetries between the foreign investors and the country's borrowers. And then this fundamentals disconnect happens because foreign currency borrowing actually does not depend on fundamental per se, but on the disagreement on the fundamentals between the foreigners and the domestic borrowers. And then in the model, we're going to assume that the domestic borrowers have an information advantage, but this is motivated by a large literature that has documented this information advantage. For instance, domestic investors outperform foreign ones in domestic markets. And then we are going to provide evidence for this expectation channel and for the information advantage of domestic borrowers. How are we going to do this? So we use the model to characterize situations where domestic agents are relatively more optimistic. And we're going to show two things. First, in these situations, domestic agents borrow more in dollars. And second, in these same situations, borrowing in dollars happens to be cheaper ex post. Okay, so these are situations where actually the excess return in the peso is higher, is positive. And then we're going to reconnect fundamentals with foreign currency borrowing conditional on public signals. Okay, so you have an unconditional disconnect, but a conditional reconnect. I'm going to explain how we get this. Okay, so let me first present the model. It's a very simple two-period small open economy model where we have a continuum of domestic borrowers that borrow fixed amounts, and they have to choose whether they borrow in dollar or in peso. We have foreign investors that have an infinite supply of funds, so they're going to price the interest differential. And the central bank, well, in the version that I will present today, the central bank will not play any role. But if you want to read the paper, then we have a central bank that also behaves strategically, but here the exchange rate is going to be exogenous. In a sense. Okay, so it's simple version of the model. So first period, the domestic borrowers can borrow either in domestic currency, in peso at rate R, or in foreign currency, the dollar at rate R star that we normalize to 0. And then in the second period, they repay their debts. We assume that the peso-dollar exchange rate is 1 in period 1, and in period 2, the central bank can devalue the currency, and then the exchange rate becomes 2. So this gives you this very simple payoff table. So basically, if you borrow in dollar and there is no devaluation, then you pay the dollar interest rate, which is 0. But if there is a devaluation, then the dollar costs more, and then you have, well, the cost is 1. If you borrow in peso, you pay R, the peso rate, whether there is a devaluation or not. Okay, so basically, if you believe in the strength of your country's fundamental, you don't believe that there's going to be a devaluation, you will borrow in dollar, whereas if you are not too confident in your country's fundamentals, you will borrow in peso. Okay, as I said here, the exchange rate is exogenous, and we assume that the decision of central bank to devalue depends on the state of the fundamentals, and there's going to be devaluation if these fundamentals are below threshold theta star. In an extension, this will be endogenous, but here it's simpler to assume that it's exogenous. Okay, so so then the agents are going to have some information on these fundamentals. There are some public signals that are observed by everybody, so both the domestic borrowers and the foreign investors. So there is a public signal mu. That depends on the fundamental, but there is a noise, lambda. And then the domestic agents have an informational advantage because they receive a private signal, so an additional signal, xi, that depends also on the fundamentals, but has idiosyncratic noise. Okay, so they receive additional information. Whereas the foreigners, they only observe the public signal. So the interest rate charged on peso is going to be related to the devaluation probability formulated by foreign investors. So the difference between the peso and the dollar rate is going to be equal to the expectations of the foreigners, which is the probability that the fundamentals are below the devaluation thresholds, conditional on the public signal. And then the domestic investors will also form their own expectation on the devaluation probability. And this devaluation probability is conditional on mu, but also on their private signal. And then you're going to have a distribution of these borrowers. Some of them will have pessimistic signals, and they will, some of them will have relatively optimistic signals and they will borrow in dollars. So they believe that the probability of devaluation is below the interest rate differential. So they are more optimistic than the foreigners. Some will be more pessimistic and they will borrow in peso. And then there is one guy that is going to exactly agree with the foreigners, given their signal. And this is the threshold borrower. We call him X star. It depends on you. And then the share of peso is going to depend on this marginal borrower. So basically, everybody that gets a poorer signal than this marginal guy is going to borrow in peso. So this will give you the share of peso borrowing. And this share of peso borrowing will depend both on the fundamentals, but also on the signal. So basically, depending on the signal the agents will get, you can have that the domestic borrowers are on average more optimistic, so there will be an increase in the dollar borrowing. If they are on average more pessimistic than the foreigners, they will borrow more in peso. So this is how it works. So we have a proposition that says that for given fundamentals, a more optimistic public signal leads to a lower share of dollar debt. And on the opposite, so this is a bit what you know, like the story of original sin, that if you have bad fundamentals, you have more dollar borrowing, but what we say here is actually the signals. Okay, when you have poor signals that you have more dollar borrowing for given fundamentals, so you need to control for the fundamentals. And then the opposite, so for a given public signal, better fundamentals lead to a higher share of dollar debt. So it's actually the opposite of the common wisdom. So to explain the intuition, I think it's useful to look at the equation. So basically here, what matters is the elasticities. It's the elasticity of expectations to public signals and to fundamentals. So let's look at the equations. All right. So here on the left-hand side, you have the expectations of the foreigners. And these expectations depend only on the public signal mu. Okay. On the right-hand side, you have the expectation of the domestic borrower. And this expectation depends on the two signals of the borrower, the public signal and the private signal. And this private signal depends on the fundamentals. So given public signal, the domestic borrowers get additional information on the fundamentals through that signal. Now, if you look at the elasticities, if you look at the elasticity to the public signal, obviously because the foreigners, they only get public signal, they will react more, the expectation will react more to that public signal than the expectation of the borrowers. And then, because the borrowers are the only ones that get an additional private signal, they will also react to the fundamentals through their private signal. Whereas the lenders, the foreign lenders, they will not, controlling for their public signal, they will not react to any change in the fundamentals. Okay, so what this gives you, in the end, the foreigners are more sensitive to public signals, controlling for fundamentals, whereas the domestic borrowers, they are more sensitive to fundamentals, controlling for public signals. And this gives you a result which, you know, so take, for instance, a more optimistic public signal for given fundamentals. Well, because the public signal is more optimistic, everybody's going to be more optimistic. Okay? But the foreigners are going to be even more optimistic. And then this means that the interest rate differential is going to decrease a lot relative to the expectations, the valuation expectation of the domestic agents. So from the point of view of the domestic borrower, then the borrowing in peso looks even more cheaper. And then this is going to lead to less dollar debt. And then the opposite happens when you look at the role of fundamentals. So imagine that now you have stronger fundamentals given public signals. So be careful here, because if you fix public signals, you have to, the noise, you need to have a decline in loss to offset the better fundamentals to get the same public signal. But imagine that you have, okay, stronger fundamental for given public signal, then the foreigners, they're not going to change their expectation. They only observe the public signal. But the borrowers, they get some information through their private signal, and they're going to be more optimistic. So in this case, you know, they decrease their devaluation expectation while there is no change in the interest differential. So this is going to lead to more dollar debt because, well, here dollar debt is going to look cheaper from the point of view of the borrowers. And this is what gives you the prediction here. For given fundamentals, then more optimistic public signal lead to a lower share dollar debt, whereas for given public signal, better fundamentals lead to a higher share dollar debt. So this means that when you control for public signals, you should see some effect of the fundamentals and vice versa. However, now so we're going to test this in the data, but notice also that this is a conditional reconnect, but this does not necessarily mean that you have unconditional connection between fundamentals and dollar borrowing. Okay, because unconditionally, when you have an improvement in fundamentals, you have both an improvement in theta, but also in mu. So these two effects can compensate each other. Okay, so we're going to test that in the data. We do this using the data from 15 emerging economies. So we're going to use quarterly data from the 90s to 2019. As a measure of foreign currency borrowing, we use aggregate data from the BIS. And it's the proportion of new bonds issued in foreign currency by the private non-financial sector on international markets. And we need two things. We need a measure of public signal, and we need a measure of fundamentals. And those two things are challenging. As a signal of fundamentals, we use credit ratings from S&P because it's the most populated one. It has been shown that this is actually a variable that is very salient, and foreign investors pay a lot of attention to it. So this is what we choose as our measure of public signal. And for the fundamentals, we use macroeconomic information. Typical variables that are used to predict the exchange rate, like the current account, international reserve with GDP growth, the government primary balance, some measure of government effectiveness and exchange market pressure. Note that not all of these variables are in the information set of rating agencies when they produce their rating. Because macroeconomic data is typically available with a lag. So now we observe the macro information about one particular period, but at that particular period, it's not public information. Okay, so these are a measure of fundamentals. And then we need to aggregate this information. So to aggregate all these different variables in one number, we regress the appreciation rates of the currency between T and T plus 8, so in 2 years ahead appreciation on the fundamentals. And then we use our regression to predict appreciation, which is actually our measure, synthetic measure of the fundamentals. And then we test our predictions, which are that, so here we regress foreign currency borrowing on fundamentals, basically. So the higher this term, the stronger the fundamental. And on ratings, here the ratings are in a scale from poorer to better, okay? So we expect beta 1 to be positive and beta 2 to be negative. So stronger fundamentals should lead to lower foreign currency borrowing, and stronger fundamentals should lead to more foreign currency borrowing, as the model predicts. Then what is very important here is to control for risk, because ratings can also signal increased risks for the country, and risk can also drive the UIP deviation. So this is we want to identify the expectation channel, so we need to control for risk. So we include measures of country risk, and we instrument the ratings with exchange rate forecasts from consensus economics, so we take the 8-quarter ahead depreciation rate. So this is first order regression when we simply try to predict exchange rates. And here you have all our fundamental measures, so I'm not going to spend time on this, but they have the correct signs. And here are our results. So here, let me show you first. So column 3 is the OLS, where we have our risk controls. And we see that stronger fundamentals lead to more foreign currency borrowing, whereas poorer rating, So what can generate foreign currency borrowing? It's stronger fundamentals or poorer ratings. This is what it means. And here you have the IV where we instrument the ratings, and you see that we still have the right signs, and it's actually even higher. Okay. So last thing that we do. So first, this is what the model predicts. So this is in support of our theory. But what we want to see is whether these situations where whether it's driven by fundamentals or signals, are these situations where actually foreign currency borrowing is cheaper. So we measure the currency excess return using the forward premium. So this is standard. In the literature. So the forward rate minus the realized interest, the realized exchange rates. But then this has two components. This can be driven by the risk premium and by expectations. So we have another measure which is simply the expectation errors. Here again we use the consensus economics forecast. All right. So here are the results with the excess return, and here is the result with the consensus errors. What we find is that the fundamentals generate an excess return in the peso, whereas the rating generates the opposite. What it means is that, well, these exact situations where these domestic borrowers borrow in dollar are actually ones where the peso is actually more expensive than the dollar ex post. Whether it's driven by fundamentals or by the ratings. That's it. So just to close here, so we have a model with asymmetric information between foreign investors and domestic borrowers. We have an unconditional, we show that there is an unconditional fundamental disconnect, but a conditional reconnect. We can also explain the sigma effect to some extent if you think of past crises as also being part of the information set of foreigners. And then in our empirical analysis, we show the effect of sovereign ratings versus actual fundamentals. And we show that firms choose foreign currency borrowing out of relative confidence in domestic currency. And that reflects actually better assessment of domestic fundamentals by domestic borrowers, at least on average. So I stop here. Do you have any questions?
It's almost terrifying to be in this room because here's where I've been taught econometrics. And in the midterm of that exam, only one person out of 40 passed. So it's a bit of a, so if I don't deliver well the presentation, you know that, I'm still a bit terrified by that. Traumatized, exactly. So this paper is joint work with Rob Check, who's a colleague at the bank, and Fernando Guerra-Martin, who's an ex-colleague at the bank, who's now enjoying life and money in Brazil. And the paper is titled Dash for Dollars. So the starting point for this paper is a chart that most of you are familiar with, which is what happened in global corporate bond markets over in the run-up to the COVID crisis. So I've got here an average of corporate bond spreads issued by a lot of firms in a lot of countries, in a lot of currencies, from January 2020 till April 2020. And as I said, most of you are familiar with the large increase or widening in credit spreads by these non-financial corporates around the world. Now, of course, what was going on in the background, you had deteriorating firm fundamentals, the expectation of future revenues of these firms were going down massively because of the lockdowns. which partly contributed to this increase in spread. But also another very important feature of what was going on at the period was what was labeled a dash for cash, which basically implied that investors in need of liquidity, of cash to maybe meet some liabilities, were selling or maybe fire selling their assets to obtain that cash. Okay? Now, a fact that was kind of, at least in our view, overlooked in that period is that if you split this average by considering only dollar bonds and all other non-dollar bonds in the sample, what you observe is that the spike in spreads was so much larger for dollar bonds than for non-dollar bonds. Now, this is a simple average across a lot of bonds. Of course, it could reflect any kind of selection, sample selection. You know, it could be that bad firms are those issuing dollar bonds, and you know that's why you observe the spread, or you know the investors who are going down the toilet were like those who are holding those dollar bonds. Now, what we want to do in this paper, we want to exploit this very large cross-sectional information on corporate bond spreads to try and discipline the interpretation of these facts. Okay? And in particular, the narrow question we want to ask is, was the investor sell-off? So, sorry, let me clarify. We want to speak to the dash for cash explanation. So we don't want to speak about what happened with firm fundamentals or expectation about cash flows and future dividends. We want to think about the dash for cash, and we want to ask whether in the dash for cash explanation of these increased spreads, this currency denomination played any role. And so the narrow question I was trying to say before is, was the sell-off of these assets more severe for dollar bonds than for non-dollar bonds? And if that was the case, why? Okay? Now, what do we think this is important? The kind of big picture question we're after is whether we can speak to a now very large and established literature on the dominance of the US dollar in the international monetary and financial system, and we want to be able to say something about that and maybe learn something new about dollar dominance in the world. Now, the challenge, I kind of already alluded to it, is quite a tough one. It's going to be hard to disentangle firm fundamentals from investors' behavior. And the way in which we're going to try and tackle this challenge is by using a panel diff-in-diff strategy, which is going to exploit a very peculiar feature of our dataset, which is that there are some firms in this big dataset that issue bonds in multiple currencies. And once you have the same firm issuing two bonds in the same currency, maybe of the same maturity, maybe of the same size, then you can do a very nice kind of diff-in-diff by controlling for firm-level fundamentals by means of a firm by-time fixed effect, which is exactly what we can do. So that's the first step of the paper, and what we do with this kind of large data set and with methodology is to establish some novel facts on corporate bond spreads. Then we want to understand the why aspect of it, and so once we establish this stylized fact, we go to a narrower data set. So now the data set is not global anymore. We kind of drill down in some data that we access to in the Bank of England, which is a regulatory data by the Financial Conduct Authority, where we have information on each trade by UK regulated firms. And now we have a lot of information to try and dig a bit more in the result, and what we show is that first, this kind of increase in spreads or falling price for dollar bonds was effectively driven by a large amount of quantities of dollar assets, dollar corporate bonds sold relative to non-dollar bonds. And second, we're going to try and, that's what I forgot about moving ahead with the slides. And the second thing we do with this kind of more granular data set is to link our results to two features of dollar dominance in the world. One is the dollar as a medium of exchange. This explanation is going to put as an important explainer for our results the superior dollar liquidity, the superior liquidity of the dollar relative to other currencies. And the second one is the dollar as a unit on account, which basically means that we have dollars in our balance sheet, and in particular in our liability side. And I'm going to speak to these points. I'm going to clarify exactly what we mean, but just for the moment, bear in mind that these are the two explanations we're kind of pushing for. Okay, starting with the data. So as I mentioned, we have this very large data set on global corporate bond spreads. We have information on many countries, many companies, and so on. We have bonds issued in 5 major international currencies: the euro, the dollar, of course, pound sterling, Canadian dollar, and the Australian dollar. We do have information on yen, but it's like few bonds, like hundreds instead of thousands, and so we dropped that, even though it doesn't really make much of a difference. And as I mentioned already, what we're going to do here, we're going to take this enormous data set and shrink it quite a lot, because what we want to keep is only multi-currency firms. We want to be able to exploit this natural, nice diff-in-diff aspect of bonds in multiple currencies issued by the same firm. So our ending data set is a data set with 3,000 bonds issued by around 225 firms in almost 30 countries. So this is the same chart I showed you before, now with some kind of bands to give you an idea of the very large cross-sectional heterogeneity that there is here. So these are kind of the interquartile, actually the 5th and 95th percentiles of the data. And these yellow bars denote the period we're going to be focusing on. This is a purely arbitrary choice, but again, I can show you robustness. It doesn't really matter whether we start earlier in our data set. The important thing to note is that we're going to stop our exercise just before the Fed intervene in corporate bond markets. Right, so the beauty, at least the reason why I'm excited about this paper is because it's just a bunch of OLS regressions, which are super easy and very robust in their results. So the first regression I'm going to show you is a very simple regression where I kill the time dimension. Okay? So delta SBI is the change between February 28 and March 20 for the spread of a bond B issued by a firm I in our data set. Okay, so there is one data point per bond. I'm going to regress this change on a constant, a firm fixed effect, crucially. So again, I'm going to kill any firm that has just one bond. Okay, and I'm just going to exploit the differential increase in spreads between a dollar bond, denoted by this dummy USD BI, and a non-dollar bond. So the way in which you should think about this beta 1 coefficient is over that period by how much, on average, dollar bonds increase by more relative to non-dollar bonds. Okay? It's super, super simple. The answer we get is this enormous number, 120 basis points. Remember, this is within a given firm. Okay? Next, we can leverage on the granularity of the data. The data is actually daily, and so we can go to a more conservative specification where now we reintroduce time. So now this object is the daily change in a bond B issued by firm I on day T. We have now around 20 trading days in our data set, and we can add a firm by day fixed effect. So the thought experiment now is on a given day for 2 bonds issued by the same firm, one in dollar, one in non-dollar, which is the bond that experienced the larger change in prices, which is the coefficient beta 1 again, and again, you get a very large and very statistically significant coefficient. Remember, this is a daily change, so if you multiply it by around 20 trading days, you get exactly the same number. It's actually 17 days or something. You get the same number as in the average effect. Again, we can leverage even a bit more on the data and ask, how does this effect evolve over time? And so what we're doing here, we're interacting the previous coefficient I showed you with a weak fixed effect. So I'm going to give you an idea of how this thing evolved over time. Okay? So the way we should think about the product of these two coefficients is week by week, the daily average effects that I showed you before. And that's what we get. You see that in tranquil times, or when the turmoil period started, there was basically no differential effect between dollar and non-dollar bonds. And slowly these effects really ramped up to being almost 20 basis points on average in a given day. Remember, this is on average for a given week, but it's daily data, so it's enormous. Okay? No, this is all trades. Actually, it's not even trades. I'm going to go to trades later. These are bonds traded in the secondary market for which you get a quote on their price when I phone you up and say, I want to sell Apple bonds. What's the price? You tell me a price, and the trade may or may not get executed. So there are a bunch of issues on why you may not want to have quotes rather than trades. The beauty of this and the beauty of having this data set is that it's global, and it's almost impossible to get a global data set with effective trades. We're going to get to trades in the second part of the data set, and I'm going to show you exactly the same results as here. So as I mentioned, this fact is unbreakable, really. You can even run firm-by-firm regressions. There are some firms that have hundreds of outstanding bonds, and you can just take, Vodafone or Apple, and you run the regression within a given firm, even without exploiting the panel dimension, okay? Just exploiting the bond within a given firm. I can talk to this later. But let me jump into the second bit of the presentation, where we now use a different data set. As I said, it's a smaller data set. It's a UK focused, even though it covers quite a few European firms as well, because they're regulated by the UK regulator if they engage in a trade with UK firms. We have data we have only kind of recent data from January 2018. We've got a lot of trades in corporate bonds. We're going to focus on a sample that is comparable with the one that we have in the global data set. And crucially, as I said before, now we're going to focus on trades, and we also observe counterparties. So now I know for that dollar Apple bond that we were looking at before relative to the euro Apple bond, let's say, that I used to look at before, now I know who traded it, who was holding it, who sold it, who bought it, and so on. We're also going to merge this data with some data. It's not easy, but we got some data on, well, the first bullet is easy. We can get the info of the bonds being traded, and we can match all of that. And we can also match the information of some of these investors. We can retrieve information on their balance sheets, okay? So we know the identity of these guys. Some of them we know actually what was in their balance sheet in terms of dollar and non-dollar stuff, which is going to become important at the end of the presentation. So the first question we want to answer is, so far I showed you some falling prices for non-dollar bonds or increasing spreads for non-dollar bonds based on quotes, okay? There's nothing that tells you that quantities move the right way, in which I kind of conjectured, and also there is the issue about quotes versus trades. So the first thing we want to do is to see, is it true that an investor holding two bonds, $1 and one non-dollar, sold the dollar bond more than the non-dollar bond? And to do that, we have this super tight specification where now we have the volume. Actually, this is a net volume, so it is a measure of the quantity for an investor J for bond B issued by firm I, okay? And what I can do, I can add this beautiful firm by investor by day fixed effect. So the thought experiment is, I'm an investor, I hold two bonds by Philippe, one is euro denominated, one is dollar denominated. On day T, on that day, did I sell more the dollar bonds relative to the euro bond? Okay? And that's what the beta 1 coefficient, again, is going to show us. This is what we get, a negative and statistically significant number, meaning I actively sold more my dollar bonds relative to the non-dollar bonds in this super tight specification. And this coefficient actually comes from the investment grade. Here we have sorry, I forgot to mention, in the previous bit, we only had investment grade bonds. Here we have a distinction between investment grade and high yields. Remember that this result comes from the investment grade because it's going to become important in a second. And actually, this net volume you can also do by buy volume or sell volume, and it's really the sell volume that is driving the result. It's not that I bought less of the dollar bonds relative to non-dollar bonds, okay? Again, with the same trick of the weak fixed effects, I can show you how this effect behaved over time, and it nicely follows the same pattern that I had for the prices. Now, the tricky bit, once we believe that this fact is there, why is this fact, how can we explain this thing, okay? And so we're going to put forward two hypotheses based on dollar dominance, as I mentioned. The first one is going to put ahead as an important explanation the role of dollar liquidity. So what do I mean by that? So I mean that I think it's generally uncontroversial to say that we think of the dollar as being the most liquid international currency. Okay, so that means that if I want to transact something, the liquidation cost of an asset is probably lower in dollars than in other currencies. Now, there are interesting papers and theories stating that in a fire sale situation, if I can choose between selling a liquid asset and an illiquid asset, what I'm going to choose first is to sell my best asset, my most liquid one. The reason is I'm going to minimize the loss I'm going to make on the fire sale. If I try to sell you crap in a fire sale, I have to sell it for zero. If I try to sell my best asset, I can minimize that loss. Now, it obviously follows that if the dollar effectively is more liquid than non-dollar bonds, then that's maybe what investors try to do. So the approach we're going to do is to say, okay, let us measure liquidity, and we measure liquidity with effective bid-ask spreads in our transaction-level data set for bond B issued by firm I on day T, and we run the same specification just to check whether it is true that ex ante, so in the pre-crisis period, dollar bonds commanded a negative liquidity premium, or the bid-ask spread was lower for dollar bonds than non-dollar bonds. If that's the case, then we can actually say, well, this theory is probably a good description of what happened over the period. When we do that, and despite the structure of fixed effects you put in, it's actually what you find. You find that there is a negative or a lower bid-ask spread for dollar bonds relative to non-dollar bonds. Remember, this is within firm, within day. So we're comparing, again, two bonds issued by Philippe in two different currencies. Now, here's the twist. That is a very interesting finding of the paper. We then looked, we said, well, this liquidity story is maybe important, but what happened during the crisis? What happened during the run-up to the turmoil period to these bid-ask spreads? And the answer is here. I jumped directly to the kind of time-varying specification. What you see is that for the investment-grade bonds, this bid-ask spread for dollar bonds became actually positive. That means that now it's suddenly more expensive to liquidate dollar bonds relative to non-dollar bonds. And this is very surprising because, why on earth should I sell that? Should I sell these bonds if it's more costly for me to liquidate them? And this is something that has been shown using other proxies of liquidity by other people, and it's called a liquidity inversion. The explanations that people put forward so far is that these investors are myopic, they don't check what's happening in the market, which is it's something that is a tentative explanation, and in the last 1 minute I want to speak to that. So maybe one reason why people kept on selling dollars despite of their higher liquidation cost is the fact that we all have dollars in our balance sheets, and especially on our liability side. Now, I'm going to go quickly here, but imagine that I'm an investor, and relative to another investor, I have more dollar liquidity needs because I have more people coming to my liability side and asking for dollars. Is it true that I'm going to sell more dollar bonds than you do? Okay, and that's the nature of this very last specification. So we're going to interact this dollar share, which I have no time to describe, but really think of it as a measure of how much dollar runs I have on my liability side, and what we find is that indeed I had to sell more dollar bonds relative to a counterfactual investor that had less liquidity runs or a run on dollar liabilities. And so our explanation here is that, despite the higher liquidation cost, because I have all these dollar liabilities on my liability side, I actually was happy to pay the liquidation cost because the alternative would have been to go to FX markets, and we know that in FX markets, borrowing dollars synthetically was very expensive. Okay? So I'll stop here. We have some bunch of facts. We think of the dash for cash as really a dash for dollars. We think that this is important for policy, and especially for swap lines. And we think that these facts should be taken seriously when it comes to modeling the special role of the dollar in the international monetary and financial system. Let's stop here. Thank you very much.
All right, you see everything. So thanks a lot for including us in the program. It's been a great session so far. And so this is a paper joint with Samuel Malamud at just continuing with the Lausanne theme in the session in EPFL, and then Haonan, who's a PhD student at Princeton. And it's called International Pecking Order. The paper is less big than what the title sounds, but that's what it is. Okay, so the background is we know that foreign currency financing is important for emerging markets. It's risky, but then also we know from Juliana's work, also papers that we saw today, a little bit that it's actually growth intensive. It can be good. And so there are three other things that we know, and we'll take that as given when we start this paper, is firms usually in emerging markets, they do not hedge these exposures.
the dollar or any other safe haven currency that they borrow in tends to appreciate in downturns, which is bad for them. And access to foreign currency funding leads to high investment and growth. And what we know is what happens when firms borrow in dollars to them in crisis periods, but we don't really know. We're yet now starting to understand slowly the micro-level trade-offs that rationalize the foreign currency share that the firms, and we saw 2 papers that basically go a bit at that today. And what we will do in this paper is we'll have an asymmetric information channel, but at the firm level. And we're going to have investors and firms knowing different things, and then firms will signal with their foreign currency borrowing what kind of firms they are. And then that will have effect on basically firm earnings, etc. So that's where we're going. The first observation that really motivated us to do this paper was, if you remember Dufluger-Schreger paper at the Journal of Finance 2020, they show that when the local currency bond government return and stock market return correlation is positive, it means local currency provides a better hedge because it reduces the real value of your debt repayments in bad times. You would expect for sovereigns to borrow more in local currency, but sovereigns, when this covariance is high, tend to borrow more in foreign currency. And we looked at the corporates for this, and we see exactly the same pattern with corporates, that whenever the local currency actually provides a better hedge for you in downturns, you tend to have, at the aggregate, this is just motivation, at the aggregate, you tend to have a higher foreign currency share at the country level. And then observing this, Dufluger and Schreger, what they do is they have a model where they have risk-averse international lenders and lack of policy commitment by the government, and that kind of explains their results. In our case, there is no policy commitment by the corporate, so we basically wanted to stay with an information story, but something that really applies to the corporates. And what we have here is adverse selection and signaling. What you could also think about, we're also working on it now, is there could be moral hazard as well, and it would lead to very similar results. So anything informational asymmetry between investors and firms, that's what we're going to go for. And basically, you take a risk by taking foreign currency exposures, and our results will say the ones that are better placed to have these risks at the balance sheet are the ones that are taking it. And we'll provide some sort of both theory and empirics to this. So this is what I told you before, and this is basically the same thing in a correlation. The higher the stock local currency government bond beta, the better the local currency as a hedge in downturns if you borrow in local currency, but we actually see that the local currency debt share is actually lower for these corporates in these countries. Okay, so first we do the theory with this motivation, and what we have is an international corporate finance model, and we have firms with active currency choice decisions. They have private information about their abilities, earning abilities, and they raise money to finance an investment project. And what we find is there is a unique separating equilibrium in which firms, by choosing, so all the firms are choosing is how much to borrow in foreign currency versus how much to borrow in local currency. And then firms can signal to investors by the fraction of dollar debt that they choose their hidden type. And this will perfectly reveal everything, and this is a unique separating equilibrium. But there's one thing here that was very surprising to us, not in the theory part, but in the empirical part, and that is basically what really is a good test of this theory, is that this depends on the co-movements of the firm's cash flows and the exchange rate. So just go back to your grad school signaling. What you do is you incur a cost. So you have to, in this setup, the cost you incur with signaling is you have to have a mismatch on your balance sheet. So the more relevant case for emerging markets, which is firms' cash flows covary negatively with the dollar. So when the dollar appreciates, the firms, let's say we proxy it with stock price of the firm, the stock of the firm goes down. You would expect this firm to have more foreign currency debt to signal that they are good, because that's costly. But the reverse should happen for a firm that actually co-moves positively with the dollar. When the dollar appreciates, if this firm does better, then having a matched balance sheet of foreign currency borrowing and basically foreign currency cash flows is not good for them. Sorry. As a signaling device. It's good for them, but to signal, they have to have a mismatch on their balance sheet. So these firms, if they have a higher foreign currency share in their debt structure, that means they are worse firms. And this is what we're going to test with in the empirics as well. And this is really the distinguishing prediction of this theory. So basically, the takeaway from the theory will be firms, they will signal to their creditors by taking on risks from currency mismatches when there's adverse selection. And just so you know, the hedging motive for the firm will still remain. This signaling is, so the firm does not want to take risks, so they want to hedge, but then they play a game with the investors, they want to get the funding, so then there are these competing forces with the adverse selection and the hedging motive. I'll show that as well. And then we do the empirics. Basically, the testable prediction coming out is the currency composition of debt is going to be linked to future performance of the firm, depending on the co-movement between the exchange rate and the cash flow for this firm. What we do is we take the Capital IQ data set, which gives you basically firms to their regulators. They have to report line by line every bond, every loan that they borrowed in, and then we have a lot of information. We just use for this paper, we just use the foreign currency share that we construct from this data set for 19 emerging market countries and a lot of firms. And what we do then is basically we take the foreign currency share and the change in foreign currency share, because that's kind of more relevant for the theory. Because in the theory, what's going to happen is you have an investment opportunity. You're choosing whether to fund it with foreign currency or local currency. So the change really fits more with the theory, but we do both. That predicts your future earnings. And for this, what we use is EBIT over assets in all specifications. This is important because we have to take out the interest payment part of it. We're focusing on the earnings because the interest payments will be a function of what you borrowed in. So what we do here is we just look at earnings before interest. So we do two things. One, we look at the full panel analysis, and we have a lot of controls. We even have like country, year, industry fixed effects to just isolate the same industry in the same country in the same year. We have firm fixed effects just to see if like any firm is better than others, etc. And this will basically survive that. Then we look at two event studies. One will be COVID-19. We're going to take the foreign currency share in 2019 to predict earnings in 2020. And then we're going to look at major depreciation episodes, which is depreciation of the local currency against the dollar by 20% within a year. We'll take all of these and then see firms that actually borrowed more in foreign currency, did they do better when the currency depreciated? And we'll find evidence in favor of this. So then basically what we do is the key prediction of the model. We'll take this beta about the stock return of the firm and the dollar versus local currency, and then we're going to divide the firms into two, the ones with negative beta, the ones with positive beta, and the prediction of the theory is they should move in opposite directions, and that's also what we find. Very good. Let me skip the related literature, but there are three papers basically. One is the Dufluger-Schrager. They do pretty much a similar story as ours in a sovereign debt setting with policy commitment. We have it in a corporate setting with adverse selection. My other paper with Semyon, basically the key similarity between this paper and that paper is that it's a firm supply issue that really is happening behind the scenes. And this co-movement with the cash flows and the dollar was a very important factor in that paper as well, but that was more suited towards global multinationals and basically dollar-euro borrowing. But this is really about emerging markets. And then Juliana's paper with Liliane, which is basically there's a UIP deviation and better firms actually select themselves into it. In our paper, there's not necessarily a UIP deviation, it's a pure informational story. And yeah, so that's kind of the main differences. And then we have this co-movement again, which is kind of different from their paper. And then once you take these results, what does that mean? That was basically my question to Philippe as well, that what this really says is we should have a look at what we think about firms that borrow in foreign currency. So it is risky, but really the ones who can handle this risk can do do borrow more. And then unless there's a big shock, they are better placed to have these risks in their balance sheet. So the model, let me quickly pass through the model. The firm doesn't have enough cash. They have to fund an investment project. It has a fixed investment cost, I. And they basically choose only between the currency denomination of this debt. They borrow in local currency or they borrow in foreign currency. They choose the face value of the debt, both of them at time 0. And then there are two variables that basically become realized at time 1. One is the cash flow of the firm. 2 is the exchange rate. And then the firm, it's super simple. If they can pay, they pay. If they can't pay, they default. And in the debt market, what they face is an adverse selection problem. They have a hidden type, mu. And then only the firm knows the hidden type. And the creditors see the share of foreign currency versus local currency, and then they price the debt according to this. And then the amount of debt that they choose will be pinned down by a budget constraint, depending on the price. Two assumptions, just to make everything super simple so that we don't have anything really deep going on, is firms with a higher type, they have higher cash flow expectations. If you're a higher type and you can signal it, everyone will know that you're a better firm. And the creditors are risk neutral, they don't discount, and what is priced is only the default probability. And basically just a technical thing, we look at fully revealing separating equilibria with rationing, and only types above a certain threshold get funding. That is priced risk neutrally, and then basically what I said, that's the assumption, that the higher type receives higher cash flows in expectation. And the main result that we take to the data is if you're a negative beta firm, if when the dollar appreciates you have lower expected cash flows, then borrowing more in foreign currency will signal that you're a good type, and vice versa. So this is what I said about the hedging motive versus the signaling motive. So this basically shows the main result very clearly. So the x-axis is the beta, and the more you go, the more negative it becomes. That means as the dollar appreciates, you do worse. So fix the type, and on the y we see the firm type. So fix a given type. What you see is the more negative your beta is, the lower you borrow in dollars. Nothing surprising there. And then if you fix the beta, that's the information story. That's where we have the theory. That's the main predictions are coming from. That is fix the beta. We're the same firm that does the same thing when the dollar appreciates, depreciates. But if I'm a better type, I will have a higher foreign currency share of my borrow. So that's basically the theory in a graph. And then what we do is we just go and test this empirically. We just separate the betas, and then we have the prediction of better or worse firms. And better or worse just means earnings before interest and taxes divided by assets next year. And yeah, we have this from Capital IQ, which really is super rich. It's very hard to construct, but we have done it now, so it's very rich and has a lot of information. We have a panel from 2005 to 2021. We have 19 major emerging markets. And we get the beta from rolling regressions of overlapping stock returns of local currency and the dollar. Let me skip this. So this is just, and in the results that I'll show you, mostly we'll focus on firms. So we'll look at the basically firms with access to foreign markets. But just to give you a flavor, but the result holds the same if we have all the firms included. But I'm not going to show that to you today. Larger firms tend to borrow more in foreign currency. Nothing surprising there. And if you look at firms that borrow in foreign currency more versus not, there's, in terms of like z-score, current ratio, etc., they're kind of comparable. When you look at negative beta, positive beta firms, on average, we have the negative beta firms borrowing less in foreign currency, but it's not a big difference either. And that's all the takeaway from this. So the empirical specification then will run two different things. One, we'll look at earnings EBIT over assets for a firm at next year. And we have the foreign currency share of this firm this year. A lot of firm controls. that hopefully exhaust a lot of information that the investors have about this firm. Country, industry, time fixed effects, so that we're looking at basically similar firms in the similar industry in the same country at a given time, and also firm fixed effects. And interestingly, the results are much stronger when you put the firm fixed effects in than without, just as a little information there. And then we do the same with the change in the foreign currency share from the year before to this year and predict future earnings. So, because this is an information story, we really have to make sure we exhaust everything that the investors know by looking at public data, so that this foreign currency share has actually some information in it about firms' earnings potential. So what we do is we have the current earnings, current EBIT over assets as a firm control. We have the annual stock return from last year to this year, which should hopefully capture a lot of the information about earnings next year. And we control for the co-movement between the firm stock and the dollar. In terms of firm size and operation, we have the log of total liabilities, log of market cap, capital expenditures. That's also logged, I think that's a typo. And then we have the current ratio Z-score, just to capture financial soundness indicators about this firm. And in the baseline sample, as I said, all the results I'm going to show you are going to come from firms that have at least once borrowed in foreign currency, but that doesn't really matter that much. So the negative beta firms, we also did many different things. It doesn't really matter, but for the baseline, what I'm going to show you is we say, because these are emerging market firms, our null hypothesis is that they will be negative beta, and we will classify you as a positive beta only if we can reject this null hypothesis. But it doesn't matter if you just take the coefficient either. So, but that's what I'm going to show you now. Good. So this is basically the panel, full panel result. What you have is firm level controls, as I told you before. In the first two columns, we're looking at the level of foreign currency share. And in the last two columns, we're looking at the change in foreign currency share. And then the odd columns, we don't have the firm fixed effect. The even columns, we have the firm fixed effect. As you see, they seem to be a bit stronger when you include the firm fixed effects, but the result is basically the same. And no matter what we do, these are many fixed effects, so we don't really have that much power in this. But yeah, no matter what you do, the results are kind of in the same direction, same magnitude, same similar significance. Basis points higher EBIT over assets, and the average EBIT over assets is about 3%. So it's not huge, but this is something. And these are basically normal periods. Interestingly, the results are going to be a bit stronger, the coefficients. We didn't do the test, but like the coefficients are a bit higher when you look at crisis periods, which is also quite interesting. Then we look at subsamples, so you might worry that, okay, our beta is not really capturing much. We look at industries that are non-tradable, so we know that actually for these firms borrowing in dollars is risky because they're in a sector that is not tradable, and the result goes through. We have, again, the most restrictive specification here. We look at small foreign sales, similar coefficient, but not enough power. Instead of having access just once, we look at only firms that borrowed in foreign currency this year. Similar coefficient, again, a lot of fixed effects. We don't have that much power. If you look at bank loans versus if you construct this foreign currency share from bank loans as opposed to everything, it's about this, again, similar thing. If you restrict the foreign currency to the safe haven currencies, that is dollar, euro, Swiss franc, Japanese yen, if anything, a bit stronger, but again, the result goes through. And this is only for negative beta firms. Next, as I promised, we divide the sample between negative beta and positive beta firms. And what you should look at is the first two lines and the last two lines, which is what we expect is the first two lines, we expect the coefficient to be positive because these are negative beta firms and having more foreign currency signals that you're a better firm, so we expect them to have higher earnings. But if you're a negative beta firm, we expect exactly the opposite, and this is what we get. Sorry. Finally, we look at the major depreciation episodes for these emerging markets and COVID-19 crisis. So depreciation we classify as year on year, the currency depreciated by 20%. And we're, again, only looking at negative beta firms. This is the kind of firms that this matters. And if you had higher foreign currency share, you had higher earnings in these depreciation episodes. And interestingly, I don't have it in this slide, but if you look at the same firm, say in Turkey, we had 2 different years of depreciation. If you look at the same firm and you compare how much they changed their foreign currency borrowing, say in 2015 when there was a depreciation and in 2018 when there was a depreciation, if they increased their foreign currency share, then the earnings are higher. So we just did that, so that's not in here, but like also if you look at the firm fixed effect with these major depreciation episodes in which we see the same firm multiple times, you see that an increase in foreign currency share, exactly in line with the model's prediction, just tells you this firm did better in 2 different depreciation episodes. So yeah, so what do we take from this? It's just, this just fits in the literature of why firms borrow in foreign currencies and basically what are the implications. And I think it has implications for assessing the vulnerabilities, the right kind of vulnerabilities from currency mismatches, in that firms taking the currency risk might be better placed to have them on their balance sheets. And if you want to reduce risks, maybe the better policy choice is to reduce information asymmetries than anything else. And yeah, so obviously important things are, so how important is this compared to other channels that we saw also today, and what are the aggregate implications more than the firm implications. So that's it. Thank you.